It has been an erratic week for the S&P 500, which closed below 5,000 at 4,967 on Friday, giving back most of the gains from this bull market in a few trading sessions. Now, this is something that we had somewhat expected, as when I gave my market prediction back in December 2024, I said this is a setup which is quite bullish for the first half of the year, which could see the S&P 500 break new highs and reach 5,200 before reversing back down on the back of a rate cut, maybe new conflict wildcards and election volatility. Okay, so the reversal didn't come on the back of a rate cut. I misdiagnosed the timing there, as did many on Wall Street. Nor did it come back on the back of election volatility. We're still too early in the cycle for that to have much of an impact. But the S&P 500 did top at 5,275 on March 31st, which was just 1.4% above my initial target. And the reversal did come on the back of a conflict wildcard. And while I don't take a lot of pride in reading the tea leaves, it turns out this time I was right. Now, however, so far we've corrected just 5.4% from the top, and two negative developments during the past week have contributed to this decline. First is the Fed's hawkish turn. Powell, in a statement, said basically that rates would likely need to stay higher for longer as inflation data is remaining stickier than it had been in the past. This is something I strongly disagree with. I've made a video explaining why real inflation was considerably lower than what the headline CPI was given, but the Fed put themselves in a bit of a complicated situation in 2022 when they said that they were giving more value to the CPI when the CPI was undershooting the PCE. And now that the CPI is overshooting the PCE, which are two different measures of inflation, the Fed are having a hard time backing out of what they said last year. The reason CPI was undershooting PCE last year and is overshooting it now is because it has a larger component for shelter as part of the index. And the way the BLS measure shelter is extremely sticky. It does not reflect true rental changes over the course of the year. Nonetheless, this is the topic of another video. The point is the Fed are now going to stick to higher for longer rates, which shocked the markets, which were gearing up for rate cuts starting as soon as May or July. Second, there was the Iran and Israel bombings, which added a geopolitical wildcard. Will the conflict escalate? Will it not? And while I'm no Middle East expert, this is a situation which we need to follow. There has been retaliation from Israel, and this seems to be the summary of what we know so far. While explosions were reported in an Iranian city, allegedly due to an Israeli attack, Iran downplayed the incident, indicating no plans for retaliation, possibly to avoid escalating tensions. The limited scale of the attack and Iran's muted response seem to reflect efforts to prevent a wilder conflict. So, nonetheless, markets hate uncertainty, markets like certainty, and this sort of news doesn't go well with the market. Now, like I said, the S&P 500 has broken below 5,000, is now at 4,967. Do I still see us as going all the way down to 4,600? Yes, it's possible, but it's no longer my base scenario. My base scenario is for a shadow correction, which will last somewhere into May. And you can see my first target here with this little emoji at around 4,800. The second target I see is a deeper correction, like I said, to 4,600, maybe 4,550, which probably would last a couple more months into the summer. The third most bearish but also most unlikely situation is that the S&P 500 would correct all the way down to 4,100 before this bull market resuming. This could bring us well late into quarter three or even into the... However, I do not believe that the bull market has seen, and as what we've clearly seen is that earnings from top stocks have been beating expectations. Of the 41 S&P 500 companies which reported earnings last week, 70% of them have beaten Wall Street analysts' expectations for revenues and earnings. This is showing that corporate America is doing a lot better than we expected. And when we have a look at the stocks which are in our coverage, we clearly see that there's a lot of good going on. Morgan Stanley beat on both top and bottom line. Goldman Sachs beats on both top and bottom line, with revenue increasing 16% per year. BlackRock's revenue increased 11% per year. Banco ZK increased 9% per year. Taiwan Semiconductors 10% per year. United Health 8% per year. Across the board, we're seeing strong, good results. And this is, for me, a clear sign that the economy is still healthy. And beyond that, what we've really seen in the financial sector, as banks tend to be the first to open up the earnings season, is that there's been a bounce back in investment banking activity, mainly in equity underwriting, and which leads us into a couple stocks which I think are fantastic buys, because the stock prices have corrected to a level which is attractive with the last correction. They are undervalued, they show good momentum of the business going forward, and are just large moats, well-protected businesses which dividend investors like you and I need to have in our portfolios. First on the list is Goldman Sachs. About a couple of weeks ago, I wrote an article for members of our premium newsletter, the Dividend Freedom Tribe, explaining that I believed that global banking was on the way back in the first quarter, and that we clearly saw that M&A deals were going up higher, and that there'd likely be higher equity underwritings happening as well. This was clearly the case for Goldman Sachs, which increased revenues by 16% year over year, aided highly by its banking and global markets activity. Now, what we're seeing is that basically the world is growing, and when the world grows, companies, governments need to be financed. And when they need financing, they need someone to underwrite the transactions. And Goldman Sachs, which is the undisputed number one in M&A and banking, steps in. And I believe, just as Goldman's management does, that we are really just in the early innings of banking growing and this new cycle of activity of underwriting, because what we've seen is that the debt and leverage deals remain extremely muted, and will do as long as the rates remain higher than they've been in past few years. The second the Fed signals a rate decline, we'll see the debt deals come in as well to further aid all equity merger and acquisitions, which have been happening a lot, and all the equity underwriting, which has also been very strong. I believe that investment banks like Morgan Stanley, Goldman Sachs are looking extremely good, and right now at $404 per share, Goldman is yielding 2.7%. It increased its dividend by 10% last year. I expect another double-digit dividend increase this year. It is a brand which has proven itself in banking, has a culture of excellence and competitive behavior, which gives it a long-lasting moat and makes it a fantastic investment for any dividend growth investor who wants a mix of yield and dividend growth. Stock number 2 is United Health Group, ticker is UNH, which is a company which has a huge moat in America, is growing rapidly, and despite a few negative headlines recently, I'm not concerned. All right, let's dig in. So UNH is really a two-in-one business, two complementary businesses which run side by side. First, we have United Healthcare, which offers health insurance to individuals, employers, government programs, Medicare plans, Medicaid plans, as well as wellness programs and disease management and things like that. And then the second business under the UNH umbrella is Optum, which manages prescription drug benefits for individuals, employers, and health plans, as well as provides healthcare services and data solutions for healthcare organizers, payers, and so on. Both these businesses have been growing rapidly, in particular Optum on the data and analytics side, and where there is going to continue to be double-digit growth in years to come, which gives me confidence that we should still continue to see maybe 12 to 15% earnings growth rate for UNH, which should trickle down into dividends at a similar pace as has been the case historically. By leveraging their advanced data analytics and innovative technology solutions across its subsidiaries, UNH can extract valuable insights, optimize patient outcomes, and improve operational efficiency. This is what gives UNH a step up on the competition. It's its vertical integration, and it's also what has attracted some attention from the Department of Justice, which is seeking to bring an antitrust case on the basis of UNH being monopolistic and impacting consumers because of its monopolistic nature. Now, we're still only at the discovery stage of this DOJ probe. It will take them at least 5 years to bring a case, if they have a case to bring at all. If UNH decides to settle, there will be fines at that point. If they do not decide to settle, it will be years and years after that before a conclusion comes. In the meantime, UNH is going to continue to grow as a business, and the declines in price which have happened this year because of this probe, because of the market correction, and because of a cyber attack which is going to cost a one-off 30 to 40 cents per share in earnings, leaves the shares now at $500. So when we look at the TTM yield, trailing 12-month yield for UNH, what we see is a 1.5% yield, which seems pretty low, and it's a bit lower than we usually go. However, what we must remember is that next quarter in June, UNH is going to announce another dividend increase. I fully expect an increase in the order of 12 to 15% in line with their historical increases, and therefore this would bring the forward yield to about 1.7 to 1.75%, which, when we look at a company which is growing at the rate of UNH, which has a large moat and these competitive advantages, is really good and provides a very attractive. Furthermore, people have said that they don't believe that UNH will be able to continue exerting their monopolistic practices, and that there will be judicial interventions. I'm not so convinced. I believe that usually the way things work in America is that if big food is concerned, big pharma is concerned, or big insurance is concerned, they usually get their way, maybe pay a few fines, which in the big scheme of things are just a slap on the wrist to these big companies, and they keep moving forward. This gives you a bit of an idea of our process and how we think about things. When we look at stocks, we start with a micro. We have a universe of 120 stocks that we cover, which are high-quality dividend stocks, which we believe have durable moats and lasting advantages. We try and buy these stocks not only when they're undervalued and look good, but when the results are showing positive momentum and that there are underlying trends and tailwinds which we believe will make the stock do better than the market over upcoming quarters and years. This is clearly the case for both Goldman and United Health Group, and I strongly believe that dividend investors should consider buying these stocks today. I'm Sam Kovacs, co-founder of the Dividend Freedom Tribe, a service which we provide to dividend investors like you who want to retire rich on dividends, where you get weekly analysis of the best stocks, a weekly buy, watch, and sell list, 3 different model portfolios, and a community chat to discuss with other members. Don't forget to subscribe to our YouTube channel to receive more videos like this. Have a great day.